Hello, and welcome to the New Traders Playbook, episode 8. This episode is entitled The Best Loser Wins, The Paradox of Trading. So we have talked about a lot of different things that hopefully can help you as a brand new trader to become a little bit more comfortable with learning how to trade and the best things to look for within the market. But now we're going to get into probably the most important part of becoming a successful trader, and that is the mind, the psychology of trading, the paradox, that is. Your trading success has almost nothing to do with finding the perfect strategy and everything to do with how you handle losing. That is what we're going to be talking about today, because the fact of the matter is there are a million strategies out there and almost all of them can actually be successful. But there is one thing standing in your way between success and failure, and that is your own personal ability to handle losses in the market. Now, let's start with something that's really important, because the fact of the matter is that trading is really unnatural. It's not normal, all right? Everything that maybe feels natural when you're in a trading environment is most likely incorrect. It's most likely wrong, because in order to be a successful trader, you have to kind of go outside of the norm of human behavior. What that means is that if you are in the market and you start acting like a normal human, you're going to end up getting normal human results. And what that looks like is frustration, revenge trading, emotional agony, blowing money, blowing accounts. Now, most traders are actually beaten not by the strategy, but by themselves. By some of the things we'll talk about today, their need to be right, their need to avoid pain, the greed, their need to have those feelings fixed immediately, quickly. All of that is very normal, very human, but is anti-trading, okay? The fact of the matter is that the market is going to reward the trader who can lose well. That is the person who is going to succeed in the market, not the one who wins big today and blows up tomorrow. We've talked about consistency before in these episodes. That is going to be a key, not just in how you take trades, but in how you control your mind within the market. Now, what exactly does it mean to be the best loser? Because that's what the part of the title of this episode is, being the best loser wins. Well, what it means is that success, your success inside of the market, is going to come from you embracing losses, not just being okay when they happen, but embracing them and realizing that losses are a part of the process. Cutting them quickly, get to something, get out of a trade when it's not working out, and then not really taking them seriously. Now, what we mean by that is not that we don't take the concept seriously. Yes, we want to look at what happened. We want to know why. We want to try and improve our trading, but we're not going to allow wins versus losses to be the end all be all in how we feel about our trading journey. Losses are a part of the process. Begin to love them. The professional traders you'll see are not the ones who are out there, flaunting their big money trades and all that. No, what it is the people they define success, not by how much money they make, especially not how much money they make on a single trade, but how well they're executing their plan, how they're managing risk, how well they're doing over hundreds of trades, not just one single big winner. Now, the best losers also don't let one single loss turn into a disaster. If you are listening to this and you have done this before, welcome to the club. We have all been there. It is very easy to get sucked into the market and pushing buttons, and really it turns into gambling, which we've talked about before. One single loser can spiral into 10, 20, 30 losers, and then there goes a lot of money or lost accounts. Our job in the market isn't to avoid losing. Really? No, it's not. Your job is not to not lose, right? It's to learn how to lose professionally, because those are the people who are making the most money in the markets, the ones who have fine-tuned their ability to lose and they've turned it into an art. Beginners often obsess over win rates. It may be something you see a lot of, right? Online, social media. Oh, look at my win rate. I have this win rate. That's not what the professionals are obsessing over. They're obsessing over how small they can make their losers, not necessarily how infrequent they can make them. Right? Really, really important. Now I want to show you something that is a visual representation of kind of this equity curve of two different types of traders. As you can notice, the blue line here is our controlled losses. This is the trader who has an amount that they lose per day. They don't go past that. This is the trader who cuts their losses quickly, who doesn't add as the price is going against them. This is the one who is controlling the narrative. Right? They have taken control and they don't fear losses. They know that it is a part of the journey. But as you can notice, starts over here at that $10,000 mark. Over here, we're up around the $12,000 mark. Yeah, that's money. They've made money. wasn't a big giant moves, but it was consistency, right? We talked about how important consistency is in your trading journey. This is the kind of curve we want to see. On the other hand, we're looking here in the orange line with the revenge trader. Most people who have traded have had this exact same experience. You are a little bit afraid of making any kind of big moves. And when you do try to make some big moves, you make dumb decisions and you get these monstrous losses. And then if you notice, what are the biggest days? Right? The biggest days are your losing days. And then we get these small winners and then we blow up and lose again. And then we get some small winners and we blow up and lose again. Now, here's an interesting fact. Look at this last one over here. This goes from about $4,000 to $9,000. So this instance, your revenge trader actually had a good trade. Does that mean that they're successful? Does that mean that they're doing the right thing? Absolutely not, because look at what has happened to get there. We had to take huge risks, big losses, revenge trade. Right? A lot of the times, this trade right here is nothing more than just happenstance. You just happen to be fortunate enough to catch the trade on the right side when you push the button. And this is what cashing it on the wrong side looks like. This is gambling. Okay, we do not want to be in the market gambling. We want to be a consistent trader who controls our losses so that we can end up getting into the green, making money, because that's what it all is really about. Now, let's talk a little bit about the psychology of this, because the fact of the matter is your mind is everything in the market. As you saw at the beginning of this video, everything that you are going to do with your path from where you are now to success is going to go right through your mind. There are a few really important psychological traps that kill traders' success, dead in their tracks. The first one you're going to notice is loss aversion. And essentially that just means you don't like to lose. We don't like to lose. Humans in general don't like to lose. The studies say that humans feel 2 times as intensely a loss as they do a similar gain, which means that when something bad happens, it hurts twice as much as when something good happens. Yeah. That's our psychology as humans. So when we become a trader, we naturally want to avoid losses. At all costs, we don't want to lose anything to not lose because it hurts more. The next one is the need to be right. One thing we're going to have to get out of the way is the fact that our egos are in the way of our success. As a human, think about it. You have been conditioned in school, in work, to avoid being wrong. Ever since you can remember being a kid, you were trying to avoid being wrong. There were even instances where people are lying so they do not appear to be wrong, right? So what does that look like in the trading arena? Well, now losing feels like an attack on your identity. Like, no, I'm not usually wrong. I'm not bad at things. Now my ego is getting in the way, because that's what it really is. We have to be honest with ourselves. If we want to succeed, we have to be honest with ourselves. Our egos are getting in the way. We feel attacked on who we are as a person. It forces us to want to break these rules, especially when the market rewards people for bad behavior. You know exactly what I'm talking about. That looks like taking a trade that you hope and wish and dream will go right, and it just happens to, right? Once again, that's gambling, and gambling can be very, very dangerous, right? Get your ego in check. That's what's going to help you to become a successful trader. The next one, overconfidence and FOMO, which stands for fear of missing out. So overconfidence happens to all traders at some point in time. You can probably remember a time if you are just beginning your journey, or maybe even you've been around trading for a little while, and you started to do things and you found yourself successful and you're winning trades over and over and over again. And now you're thinking, well, if I'm winning so much, I must be locked in. I'm seeing the market, right? Now I'm going to oversize. I'm going to add more contracts. I'm going to take more trades because, oh, I know what I'm doing. I'm amazing. You know what happens next. The odds come after you, right? And when the odds come after you and you've doubled, tripled, quadrupled up on your size, now you lose everything that you gained during that confidence building time. Right? The same thing happens with FOMO. Right? Traders push and they chase after moves that they've missed. You got a bad entry, and now your risk to reward is terrible simply because you feared missing out. Folks, remember, the market is always offering trades. We're never missing out on anything. If you didn't take it today, it's probably going to appear again tomorrow. If you don't know your own personal biases or struggles, the market is going to gladly expose them to you and take you for every single one. Let's talk a little bit about the best of the best, right? The traders who are just killing the game. How do the best traders think in contrast to the rest the normal human, right? Because there is a big contrast between normal human thinking and professional trader thinking, right? The professionals think in probabilities. That is a big key. They know their win rates. They know that there are expected losses. They know it's a normal part of the job. They realize it is not a personal failure. They put their ego out. They push it out. It doesn't exist anymore. That's how they become professionals. That's how they become successful. They replace that need to be right with a need to be consistent. Now, we keep talking about consistency, and it's going to keep coming up because it's a key. Right? They're emotionally invested in the process, not the progress. They're emotionally invested in not how much each trade makes, but how successfully they had accomplished what they went to do, how they decided to enter that trade. And finally, they create rules and boundaries for the behavior in the market, meaning that they have the position sizing, they have daily loss limits, they have predefined setups. They're not just walking into the market with no ideas. They're not gambling. They're thinking differently than the normal human would think. That is how they become the best of traders. Now, I think it is important, especially as beginners, that you have some basic rules that can help you. But I believe these rules are really good, not just for beginners, but for even advanced traders. So step number 1, never increase your risk size in order to make back a loss. This is what we would call revenge trading, as we mentioned before, which means I just took a couple of losses and I was trading with one contract, for example, and now I want to fix that because it's painful and I want to get it back. Well, I can't just wait because now I have less money, so it's going to take longer to get back to where I was. So if I double or triple or quadruple my size and I just happen to win, gambling, right? Then it'll make me feel really good. Yeah, it never works. It will never work. All right. Number 2, predefine your maximum daily loss and stop when that hits. Period. It's not a maybe. It's not an if. It's just an is. Remember, we were just looking at this. The only way that person doesn't have these huge, giant dips in their trading is because they have a defined maximum loss. Okay. Some people won't agree with this, but I do believe, especially when you're a beginner, that you have to have some kind of reins on yourself so that you don't go having these really big loss days that will really internally hurt and hurt your psychology even more. Lastly, journal. Journaling is important, guys. Journal not just your trades, but also your emotions. You need to know where your triggers are. You need to know why things are happening and why you're treating certain things in certain ways. The more information you have within your journal, the better you can fine-tune your own personal trading journey. A couple of the things I think are important for us to remember are the fact that if you walk into the market and you expect every trade to work and every trade to be profitable, you are in for one big reality check. Emotionally unprepared is what you would be. We need to understand that that's not how anything works, especially not trading. You will lose, and the best loser will be the winner. Your edge, as we talked about a couple of episodes ago, it's your strategy, is not just simply your setup. So it's not just simply enter here, exit here. It is also the way you execute under the pressure of possibly lost money. Okay, how money changes you. It does a lot, which is why when you go from simulation trading into trading with real money, things all of a sudden change. A lot of the times traders will go in and they'll make $100,000 in simulation money. It's so easy, everything's great. And then as soon as they flip over to real money, everything falls apart. There is an amount of pressure that appears once you get into executing real live trades. This is where your setups are going to be not the most important thing, but your psychology will be. Finally, the market doesn't pay you for being a genius on one trade. It does not pay you for the fact that you did really well on that one single trade and made a few dollars. It pays you for being boringly consistent across hundreds of trades. Yeah, really quality, good trading is boring. It's not what you see sometimes with people yelling and screaming, excited about things. It's exciting when you love the market. But the fact of the matter is, boring consistency over hundreds of instances of wins and losses, that's what's going to make you into a solid, successful trader. So let's take a look at a couple of examples, because it's really important that we know who we want to be in the market. So let's say that there is a path A. This is your option. So you can enter a trade and put your stop loss, take profit, and then you can allow price to hit your stop loss. You allow it to hit it and then move on. This allows you to have those small controlled losses. Your equity curve, it dips at times, but eventually recovers because the strategy you've chosen does have winning odds. Okay, great. Or path B, which is the trader who keeps moving your stop loss because you don't want to lose, because losing hurts a lot. So you move it, and then maybe you add to your position, getting a better entry price by adding as price goes against you. It's usually called DCAing, which stands for dollar cost averaging. But regardless, what ends up happening in this scenario is you move your stop loss, and maybe sometimes you get fortunate, but on days when you don't, it can destroy everything that you have. Let's take a look at an example of what that would look like, okay? So let's say that we have been looking at price, and price is now in this uptrend. Okay? So maybe you want to trade the channels, which some traders do. They'll trade one side of the channel back to the other. So you notice it goes up and then down and then up and then down. So maybe you say, all right, I'm going to enter when price comes back to this level. So you get in, you say, okay, I'm going to put my stop loss right here. Sure. And I'm going to put my take profit up here. And fantastic. So then price comes and then it does this. It turns around. You're like, yay, everything's great. I'm so excited. And then it comes down a little bit farther. And you're like, oh no, I'm not into this. Maybe I had my stop loss at the wrong location. Well, remember, if you had your stop loss at the wrong location, you probably had your entry at the wrong location too. You are ruining your risk to reward. You're ruining how much money you can make off of how much you can possibly lose, okay? So let's say it comes and it does this and you're like, okay, well, I guess I'll just add another contract right here because why not, right? We'll just add a contract as soon as it sweeps through here so that we get a better dollar cost average, right? So that we can get up here and then we'll make even more money. Great, fantastic. So then price comes down again and you're like, oh, well, now we're in this zone. Let me just move my stop loss down a little bit more because I'm not wrong. Sure, why not? And then we decide to add again. Oh, okay, perfect. Now I'm really gonna be able to get back in this because I've moved my stop loss down a little bit more. Everything will be fine. Price is gonna turn back around and gonna make a lot of money on this trade. Okay, so price is still going against me. Oh no, what do? I've put my stop loss in the wrong place. Okay, I'll just move it way down here. Sure, why not? I'll add again. One more time. And then you know what ends up happening? Oftentimes, we don't even get to the stop loss because at this point, you've blown your account. Can you imagine what this feels like? You've probably been through it before. It's painful. It's really painful. What could we have done? Because say we had our stop loss down here. Instead, we could have just stopped here. We could have just stopped right there. No pain, no additional issues, none of this happening down here. We could have simply stopped where we decided originally to stop. Because guess what? The stop loss that you had originally was a really good idea. Because what did price do? It just continued to go against you. Adding and adding and adding and hoping for a reversal when your concept has broken, that's a lack of discipline, a lack of consistency. That is allowing the FOMO, allowing the greed, allowing the human part of you that says, I can't lose. I don't want to lose. As long as I keep moving the stop loss down, I'm not a loser. I'm not a loser. My identity is intact. Your ego is getting in the way. Push it out of the way and realize that trading is about being the best loser you can. Okay? So we know that of these two options, the best loser always takes path one. Always taking path A. All right? Now, the next thing we can think about is being right versus being consistent. So we talked a little bit about that before, but let's think about, we've looked at this chart before, which was the chart about risk to reward, which means the higher your risk to reward is, the lower your win rate has to be. People love to talk about win rate, but they never really want to talk about the importance of higher risk to rewards. Now, think about it like this. You don't have to win all the time in order to make money. We're not here to be the best winner. We're just here to make money. So if you were to have a 1-to-3 ratio, and let's say that you won 50% of your trades. So you have a 50% win rate and you're using a 1-to-3, which means every time you lose $100. That's your one. And every time you win 100 times 3, $300. Okay. Now, if you have this 50% win rate and you take, let's say 10 trades, that means that you have 5 of them, which were losers, which equaled $500. Okay. And 5 of them that were winners, and those 5 times 3 equals $1,500. Now do the simple math. 1,500 minus 500 means that you're going to profit $1,000. But in order to make this $1,000 a profit, you had to lose 50% of the time. Okay? The best loser wins. Because if you didn't lose this 50% of the time, you would not have been able to win the other 50% of the time. If you lose twice and then you blow up, you don't even get an opportunity to reach the rest of this. You focus on this portion, the losses, and you can't get access to the wins. Okay? Losing is a part of this process. It is a part of trading. It's like anything else, right? It's like gas money to go to work, food to go to work, clothes to go to work, the toll you might have to pay to go to work. They are all a part of the process. We have to pay the gas to get to work. We have to lose in order to get to our winners. Okay, keep that in mind. Finally, we're looking at the trader's nightmare sequence. What does that look like? It looks like FOMO followed by chasing, regret, and then revenge trading. We never want to be a part of this. We never want this to happen. The only way that we're going to get past this is realizing that the best loser actually does win. To conclude this episode, I want you to think about this question. Don't ask yourself, how do I win more? Ask yourself, how can I become the best loser in the room? This is how you're going to flip the psychology of trading directly into your favor. And hopefully that's how you're going to end up becoming a successful trader. So thank you so much for listening again today. I hope you enjoyed this episode. If you have, please feel free to like and subscribe, and I'll see you in the next episode.